right, let's begin in the United States, where the FOMC has held rates steady between 4.25 to 4.5. Let's hear from Jerome Powell, who talked about a number of things. One of them was price stability, and how it's being impacted.
I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out.
All right, let's bring in Efosa Aluyi, co-managing partner at Aztran Global Investments, for reaction. Lots to talk about. Efosa, good to see you again. Good morning to you.
It's good to be here.
So what do you make of Powell's language? Because he seems to be, talking about fiscal policy could be impacting the monetary policy path. What do you make of all this?
Exactly right. The truth of the matter is that we're in unprecedented times. I mean, we've had this before with Donald Trump 1.0, right? But, I mean, it just feels a bit more chaotic this time around in terms of policy direction, in terms of policy clarity. And truly, markets and monetary policy in particular just doesn't like uncertainty. So it puts the Fed in an awkward position. It puts them in a position where things can be a bit difficult in terms of them getting a clear sense of how things are going to progress going forward. And if you listen to that conference a lot, he was talking a lot about just not knowing a lot of things, right? And typically, the FOMC would have a good sense of where things are headed. They'll have a good sense of where they want to go. Now, they have a sense of where they want to go. They do not know what the impact of fiscal policy would be, particularly the tariff situation. So it puts them in a rather tight situation, a difficult situation in terms of giving forward guidance.
Yeah. I want to ask you if you think the U.S. is going to fall into recession, but Powell was asked that, and I know we got a lot of Powell clips, but let's play Powell's reaction to a question from a journalist on whether the U.S. will fall into a recession.
Anderson forecast said there's a high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, there could be within 12 months a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels. Still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Efosa, what we agree, or where are you on the odds of a U.S. recession?
Yeah, I think I align with him. The odds or the possibilities have actually increased, but still don't remain significantly high, right? So we're looking at, if you look at December, the possibilities of recession were less than 10%. Now that has gone to slightly over 20%. It's a huge move,
Yeah.
but again, at 20% possibility, that's still quite low. Again, it's important to point out again that the economy remains relatively strong, right? That there's just these headwinds with policy uncertainty that could create challenges and create problems. There's obviously the scepter of stagflation as well, so that's another thing to consider. But I think on balance, worst case scenario, we're probably going to have a clear soft landing, really, a situation where economic activity doesn't slow to a grinding situation where the Fed needs to intervene heavily or significantly. Again, if we see significant slowdowns coming into the rest of this year, like the Fed has said yesterday, they really stand pat to intervene to make borrowing costs cheaper, and that should help sort of create an upward movement in economic activity, really.
Okay, Trump responded. Let's put up his Truth Social post. I think this was towards the end of the press conference or after the press conference was over. And I really want us to dig into this Truth Social post. He says the Fed will be much better off cutting rates as U.S. tariffs start to transition or ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. So first, can you speak to cutting rates at this particular time? Wouldn't that be inflationary, or what would you?
Yeah, so again, you want to go back to kind of look at that 2% target that the Fed has set. And in my opinion, I think that target is, not very realistic anymore, right?
Yeah.
The world has changed quite significantly, and to still maintain that 2% target, even over the long run, can seem to be out of sorts at this time. And that's why you've seen what has happened with inflation, where it's sort of remained really sticky, right? We've not seen it come down sustainably towards that 2% target. Now, we've seen very strong downward moves. Nevertheless, that 2% target sort of remains kind of elusive, to the Fed right now. So there's a lot of uncertainty, really. So if the president is insisting that they cut now, April 2nd is coming. We've seen those, sort of kicking the can down the road situation with the tariffs. So it really isn't clear what's going to happen on the 2nd of April. Yeah. We could get there and then there's another shift. It's just been chaotic. So it's really tough for monetary policy to clearly, follow that. But I think that in terms of, interest rate revisions, looking at the inflation outlook, yes, like you rightly pointed out, cutting interest rates at this point could potentially be inflationary. And that's why there's the talk about, the possibility of a stagflation in the U.S. economy.
Thanks for that. Let's get to this Bank of America survey of investors. And there were some reactions. We listed it out there. I want you to get your thoughts. Okay, so they said there was, according to the survey, this is, of course, of fund managers. They're looking at the largest ever drop in U.S. stock allocations. They said EU allocation highest since July 2021. Second biggest drop in global growth optimism. Biggest jump in cash allocations. And then they talk about U.S. risk, trade wars, and stagnation. So are Europe and Asia the beneficiaries here of money possibly cycling out of the U.S. equity market?
Yeah, so I think what's happening here is this idea that U.S. exceptionalism has peaked.
Oh, there's even a poll on that. Thank you. So yeah, keep going. Yes,
and that we are likely to see a resurgence in Europe. This rotation that you're seeing out of U.S. equities into European equities is the biggest we've seen since 1999, right? If you look at the fund managers within that survey that have put on a European overweight in the last month, that has gone up more than 3 times, right? If you also look at the number of fund managers that have put on a U.S. underweight within that same period, that has gone up about 5 percentage points. Now, if you look at the valuations, right, in spite of the downdraft that we've seen in the U.S. market over the last month thereabout, valuations still remain within the 90th percentile of the historical range. You go over to Europe, in spite of the upside we've seen, valuations still stay within the 50th percentile of the historical range. So from a valuation standpoint, Europe is looking a bit more appealing, right? And then you throw on top of that all of the tariff tantrum, if you will, that's been going on, creating all of this uncertainty, has kind of, significantly shifted sentiment away from the U.S. in the last month or so, right? And then again, if you look at, the kind of situation that we're beginning to see, particularly in Europe, where the German parliament essentially passed, a bill that is essentially going to shift, the fiscal situation in Germany, and that's the biggest reform, if you will, since the reunification of Germany. So the breaks that you typically would have in terms of defense spending, those are being sort of removed. So you're seeing an increase in defense spending, increase in government spending, which should create a sustainable path for growth in the largest economy in the EU over the next 2-3 years thereabouts. So that is creating some sort of positive sentiment in Europe. However, the concern really is that if you look at Europe, a lot of the big companies there are very exposed to the US, either through exports or them having themselves established in the US. So if things are beginning to sour, if you will, or slow in the US, it's certainly going to have an implication on those European companies, by extension, their earnings, valuations, and also the allure, if you will, or the appeal of the European market. I think what we're seeing is just a knee-jerk reaction rotation based on all of this tariff tantrum that you're seeing. If things kind of settle down, I think we're going to see, stocks move back, allocation sort of move back a bit. But I think that what we're seeing with Europe is a bit sustainable over the next couple of years. We've seen very strong moves in defensive stocks and all of that. So I think that is likely to continue over the next couple of years. But I don't think that we're going to see a significant fundamental shift away from U.S. equities into Europe. Great
stuff. For that's why we have you on the show. Let me go to Latin America. The Finance Minister Guevara has resigned after only being in the position for only about 3 months. He's been clashing with the president, Mr. Pedro, over spending. Is Colombia in trouble when you look at things over there?
Yeah, I mean, that's the indication that we get, and that's the reflection of what we're seeing, really. That's the first leftist president in a very long time. So obviously, they're clashing over courts and all of those sort of things. As a matter of fact, 12 of the 19 cabinet ministers have been changed since he came to power. So there's a lot of uncertainty. In fact, the peso weakened on the back of this. So there's just a lot of turmoil, if you will, and uncertainty within that economy. So, I mean, nobody likes that. Things need to be stable. We need to have a good sense of where we're going. So, in the absence of any semblance of stability, we're going to likely to continue to see all of this ruckus continue really in that country.
Let's move from there, speaking of ruckus, to Turkey. The mayor of Istanbul detained, the lira falling, stocks and so on and so forth. What do you make of the investor reaction to his arrest?
So, again, it all just boils down to the fact that markets just don't like, political uncertainty and all that kind of stuff. So over the last couple of years, we've seen Turkey really implement and carry on with unorthodox monetary policy. Yeah. And then you had the advent of the finance minister who stuck to his guns and essentially created an orthodox monetary policy situation where they had to deal with significant price instability. So interest rates, were really, really high. And what that has done really is to attract significant flows into Turkish local bonds. As a matter of fact, the yields there, you're getting anything around 40% thereabout. So you've had a lira or a Turkish carry trade going on over the last year thereabouts. We've seen the currency also strengthen. We've seen the Turkish stock exchange outperform the MSCI emerging market index. So there's been a lot of good stuff that has happened in Turkey over the last year thereabout, particularly since the crash we saw of the lira in middle of 2023. Now, this whole situation where Emrek İmamoğlu has been detained, a major opposition figure who's been seen as someone that's going to challenge Erdogan, the markets don't like that. So that reaction has been very swift. As a matter of fact, estimates put it that the central bank had to intervene with about $10 billion to stave off all of the outflows. So again, that's a major concern that is threatening to undo all of the progress that Turkey has made over the last year or two. Nevertheless, you still have a lot of investment professionals that think that in this world where tariffs and uncertainty are threatening, that Turkey still remains a really good investment destination, particularly for emerging markets.
Great stuff. Now, back to central banks. So we had a hold with Japan. We've had a hold with the U.S. We're just getting in some news that some of the Middle Eastern markets, Qatar, Saudi Arabia, UAE, they've held as well. We've got the Bank of England today. Is the stance for central banks across the globe now a wait and see with everything going on?
Yeah, it seems pretty much like that. Like I said earlier, monetary policy doesn't like uncertainty. So in a world where We don't know what's going to happen on the 2nd of April. We don't know what's going to happen before then. It's really unclear how things are going to pan out. It really makes a lot of sense as members of a monetary policy authority to kind of get a sense of or get some sort of clarity before you go ahead and act or before you go ahead and make your own move. So yes, I think the stance right now, at least in the near term, will be a wait and see one.
Yeah. Okay, that's global news, Efosa. Thanks for all the insights. I want to bring us to Nigeria now, and one of the big story in the downstream sector is the Dangote Refinery putting out a notice. I think we'll put the notice up for viewers. Yep, there it is, saying that I thought this was a very technical notice, but let me just read the first paragraph. I wanted to inform the Valley customers that the refinery has temporarily halted the sale of petroleum products in Naira. This decision is necessary to avoid a mismatch between our sales proceeds and our crude oil purchase obligations, which are currently denominated in US dollars. And then they go on further to dispel some false stories. What do you make of this decision here from the refinery? Yeah,
so again, with this, over the last couple of months, it's almost been a sort of running battle between Dangote and the NNPC. The NNPC comes out to say something, Dangote says something, so I think this is a continuation of that. I'm not totally clear how much crude Dangote receives from the NNPC. I'm also not sure that it gets the entire crude from the NNPC. As a matter of fact, when it started then, it was importing crude, and obviously you pay dollars for that, and then you were dispensing locally and still selling in Naira. So it's sometimes a bit confusing to get a proper sense of what's truly going on, and that's why I say this is just like a continuation of the, if you will, running battle between Dangote and the NNPC. However, what this then portends is that again, we don't have a clear indication as to how much Dangote is now picking up in terms of supply to our local market. If it is significant, and this could create temporary supply shocks in the market and could portend all of the issues that we probably thought we had left behind us.
I guess just one more question for you. I guess just looking at the Nigeria's oil and gas sector, downstream, upstream, do you think we're going to see some stability, possibly more production, and so on and so forth? How are you seeing things in the oil and gas space?
Absolutely. I think we've seen some gains in the last couple of months where production has kind of increased. Unfortunately, the recent developments we've seen in that region creates concern, but there aren't any indications yet as to the sort of capacity that's been shortened by what we've seen over the last couple of days. But I think that it would be the decision that makes sense for production to stay the course and even continue to ramp up. The progress that we've seen on the price stability front, is very crucial that we maintain that. And I think oil production is a very, very important mix to ensure that we actually maintain that.
Efosa Aluyi, co-managing partner, Aztran Global Investments. Always a pleasure having you to touch on these global issues, and I'm glad maybe we'll bring you back to talk more local stuff. Nigeria, thank you so much for your time. Really appreciate it.